Hey guys, what I want to talk about in this video is earnings plays. Now, I like earnings plays done a certain way. I don't like how most people do earnings plays, where they try to guess which way a stock is going to go on earnings. It's fantastic when it works out, but that doesn't always happen because, first of all, you've got to get the direction correct. And that means immediately you're sitting with a 50-50 chance of picking it right. And sometimes, even though you get the direction right, you don't make any money if you buy the option because the move has already been priced in. Let's just take a look at something that was a best case scenario, and then let's look at some other earnings from this past week. Target had earnings and they blew the price out of the water. Now, why did that happen? They had an estimate of 1.6 earnings per share and they doubled it. Yeah, they definitely blew it out of the water and up it went several delta. Let's take a look at the options before the earnings announcement and then after. So if we go and think back and we look at the in the money call the day before, which was 8/18, you can see the 136 call, we could have bought that at the close of the day for about 370. You need to think about this when you're playing earnings. What you're assuming is that by the end of this expiration, this price is going to be in excess of 136 plus $3.70 because that's what you're paying for it. The break-even price that you might get from Robinhood or by doing math is actually pretty useful because you have to think in your head, I need this earnings to come in well beyond that break-even price to make any money. And depending on the stock, you can be paying a lot for that option and you're going to need a very, very big movement to get up there. Another little trick, by the way, if you want to know what the market makers, what the market is pricing in, Thinkorswim gives you a little tool up here, the market maker move, the little number in yellow. So the market makers were estimating somewhere around a 5.6 move up or down. So if we go forward today, we can see that the next day closed at 54.22. It's quite a big movement. This would have made you quite a bit of profit, $1,400. Why is that? Well, when you get so far in the money, it just becomes simple math. How many delta, how many dollar movements of the stock are you up? So if we have the 136 call and we have a 154 strike price, then that is $18 off of our strike price. And there you go. About $18.30 would be our price. We're 18 off the strike price. This is a really best case scenario. Let's look at some of the others from this week. A lot of people played Home Depot. And Home Depot went up just a little bit, but then came right back down. Kohl's, if you were betting on it going up, you definitely lost out. Pretty much probably a full loss. NVDA is one that a lot of people played, along with the tech stocks, and it actually went down a little bit on earnings. Pay attention that they actually beat their earnings expectation by quite a lot. They had an estimate of 1.62 and they came in at 218. That's a pretty big beat, but yet the stock didn't really respond to it. And that's the nature of earnings plays. That's why I don't like playing them outright with options. You never know what the price is going to do, even if the earnings come in out of the water. You got to really blow it out to make any money on earnings, and you have to be right. So your probability of success is going to be low. But there's actually a corollary to that. If we assume that most of the time earnings plays are going to lose money, then why don't we just do the reverse? It's kind of like people when they think about they're trading and they're losing money, or they just did the opposite. Well, we're going to look at that here in a second. But first, I want to nerd out a little bit, and I want to show you guys something about options. So I filled this in on NVDA. So if we said that we were going to take a put, we were going to bet on it going down, we could have taken the first in the money put, which would have been 490 because it's trading at 45, not quite 45 in the money yet. So by that, again, we're using Thinkorswim's Think Back feature. We could have gotten that for about $16.95. Now, I'm going to punch in some of these numbers here, the Greeks, and I want to show you how these play in because this is where all the money in options is made. Without knowing this, you're going to be flying by the seat of your pants and buying those lottery tickets. So let's see how this actually factors into the option price. So I went ahead and put in the numbers for these dates here. For 8/19, which would have been the day before earnings because it was after hours on 8/19. So the share price was $485.54. The cost of the option was $16.95, which is $1,600.95. So we bumped that forward another day. We did pay $16.95 for it. Now it's all the way down, much less than that. And we lost about $1,000 right up there. So, of course, we didn't get a movement. So the price of the option is definitely going to go down. But where did it go? What factored into that? Well, let's take a look. So the real thing that kills you on earnings is the vol crush, VOL, volatility, which is implied volatility, or otherwise abbreviated as IV. Before options, IV, implied volatility, was at 82.88. The next day after earnings was announced, it dropped all the way to 27. And how this factors in is every single percent of IV that it moves is based upon Vega. Now, Vega changed from one day to the next, and it changed this many. So let's do a little bit of math here. So every percentage point of IV that we lose is going to be represented by Vega. And the Vega changes, but we're going to do some really dirty math, and we're just going to average those two together from one day to the next. And then we need to find out what the difference in IV was. So we're going to subtract these. So basically we had 55 points of IV change, and each of those is going to be for 15. So we're going to lose 825 just on volatility crush alone. Now, one more thing that we're going to lose is theta. So theta is going to be, for every day that we have this option open, we're going to lose that much. So we're also going to lose 266. So both on theta and IV crush, we should lose about 1091 off our option. That's what the theoretical value should be. And if we do the math, our theoretical value should be 6.03. And if you look, the cost on the next day, 6.57, roughly in line with that. A little bit of delta, a little bit of stuff going on there with the spread. But that's what happens on earnings. You lose on the volatility and you lose on the theta from one day to the next. So that is what is called a vol crush, and that's how it's calculated. So the question then is, if it's very, very dangerous for us to try to pick a direction, for us to try to guess right on earnings, what is something that's actually something we could use that has a statistical basis to go upon to make money? Well, this is a strategy that I like to use. I call it iron flies. Nothing really fancy about it. It's basically the combination of an iron condor and a butterfly spread. And I like to do this around earnings. And you have to be very, very selective on this because sometimes earnings can be blown out of the water. But the benefit of this is that you're going to have fixed risk. You're going to have defined risk on either side because you're selling against it. It's made up by 4 options contracts. Let me show you what happened here on lows. This is a pretty good example of something to use. Again, they were going up, 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 up. And earnings actually, again, beat by quite a bit. Instead of 2.99, they had 3.75, but yet the stock didn't move, and it went down a little bit the next day. So those earnings were 8.19 before market, so we had to get in on 8.18. Let's look at the option chain here. So what I'm trying to do here is I'm trying to build an iron condor really, really close to at the money on both sides. I want to get as much premium out of these close to at the money options selling as I can, but leave a little bit of a gap so I can make it really right. So if we're at 157.91, we're real close to 157.5. So we can't use that one. Let's use one out of it for 160. So I'm going to sell the iron condor. This is in Thinkorswim how you put this together. Other platforms, not sure, but the premise is you're trying to wrap your trade around it. We're going to choose 155 on the put side because it's the next one below the 157, which we're close to. And then I want to give myself about 5 points on either side. So we're going to say we're going to buy the 165 leg, and then we're going to buy the 150 put leg. What that's going to do is give us a credit of a little over 3. What is our risk in this trade? Well, the spread between the two strikes is 5 points. So our risk is just going to be the spread minus the credit we received. We're receiving 3. So we're risking 2. So we're actually standing to make more than we lose. The next day, when things come out, I want you to watch these numbers. Watch these numbers as we go from one day to the next. Boom, they fall off a cliff because all of that volatility has been crushed out of them. And what do we end up with in profit and loss? Well, we'd be up about $193, about $200, close to almost the full value that we sold it for. And then we can just close the position. So we've taken advantage of that volatility crush. Some earnings seasons are better than others. This one we just went through was actually very, very good because I feel that a lot of the bad news had been priced into the market already. And so earnings were not really going to change people's perception very much. But because we were coming off such a volatile year, there was a lot of volatility that could get crushed out of it. Mine this season did pretty well, but I have had seasons where there have been a lot of earnings surprises and it did not do very well. So you have to be very, very careful. If you have any questions about this strategy, in the Discord, I put out my thoughts and my process of the live trades that I took this season in the options lab. So check out that channel in the Discord if you want to know some more.